The Precious Metals Week in Review, September 18th, 2015. Brought to you by Precious Metals International. Volatility was readily apparent this week as the markets tried to predict what the U.S. Federal Reserve intended to do with regards to finally raising interest rates. Clearly, by the end of the week, global markets were disappointed with the decision. The number of Americans filing new claims for unemployment benefits fell to the lowest level in 8 weeks last week, falling by 11,000 claims to a seasonally adjusted level of 264,000. All eyes will be on the September non-farm payrolls report, which will be released the first Friday in October, to try to predict the Federal Reserve's next move. The U.S. Federal Reserve held its Federal Open Market Committee (FOMC) meeting to set monetary policy this week and announced, following the meeting, that they would not be raising rates in September as had widely been expected. Fed Chair Janet Yellen spent the news conference that took place following the announcement justifying the need to keep rates at their record lows despite what appears to be an improving U.S. labor market and economy. The main concern for the Fed has become the global economic slowdown, led by China, and its potential effect on inflation in the U.S. The statement released after the Fed's meeting said, "Recent global economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term." Analysts now expect that the slowdown in the global economy will force the Fed to wait until next year due to continued low inflation before it can attempt to raise interest rates. In Japan, despite stiff opposition, a key vote took place on Thursday that marks a dramatic post-World War II security policy shift. The vote paves the way for allowing Japanese troops to fight in conflicts abroad for the first time since World War II. Opponents to the measure say that it is in direct violation of Japan's post-war pacifist constitution and could embroil Japan in conflicts that could be led by the U.S. China expressed major concern over this change, particularly since it has been aggressively seeking to validate its disputed claims in the South China Sea. Japanese exports slowed for the second month in a row in August as China's economic slowdown continued to take its toll on the world's third largest economy. If exports continue to drop, the likelihood of additional stimulus measures from the Bank of Japan will increase as lower factory output and continued low oil prices could push the battered Japanese economy back towards deflation once again. China continued its attempt to clamp down on stock market volatility this week. A senior official at the securities regulator that was responsible for propping up plummeting stock markets was placed under investigation on Wednesday for severe violation of discipline, which likely means that he is under investigation on charges of corruption. David Roche, president and global strategist at Independent Strategy, told CNBC Asia's Squawk Box program on Wednesday, when discussing China's reaction to its plunging stock prices, "In the beginning of this year, China, came out with great reforms, but since then they've gone backwards like a drunken spider wandering across the page in various directions that are contradictory. They like it when the markets are going yay, 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 but now the markets are going nay, nay, nay. So you lock up a few fund managers and you criminalize normal portfolio behavior and you shut down the market." Mr. Roche's sentiment seems to be held by many potential China investors, as many seem to be afraid to return to that market since the crackdowns began. European markets took a beating on Friday after the U.S. Federal Reserve opted to keep interest rates at their record low levels on Thursday, increasing fears that the overall health of the global economy was still at a high degree of risk. Germany's DAX index dropped over 3%, placing it near bear market territory from its April highs. The French CAC index also saw a drop, closing 2.5% lower. Despite a trading error on London's FTSE index, which traders described as a fat finger error, that sent the index plummeting sharply on Friday, the FTSE managed to close only down 1.3%. The migrant crisis in Europe continued to escalate this week as Hungarian police resorted to water cannons and tear gas on a large group of migrants in an attempt to force them back from its border with Serbia on Wednesday. Hungary seems to have become one of the key entry points into Europe as migrants seek passage to more prosperous areas such as Germany and other northern European countries. According to research firm Idea Global, citing an interview it conducted with a reliably informed Asian source, China may be considering another 15 to 20% devaluation in the yuan by the end of 2016. Such a move could trigger a serious crisis in Asian markets. Their source said, having achieved a 3% move in a few weeks with the previous devaluation, they would not want to stop here. Their ultimate target is probably a 15 to 20% minimum move in the trade-weighted index. The first currency devaluation several weeks ago took traders by complete surprise and triggered shock and unease across markets as they attempted to decipher what Beijing was trying to accomplish. Crude oil remained stuck in the $40 range as oversupply fears remained amid the potential for further weakening in global demand as the world economy continues to shrink. The euro started the week moving basically sideways against the US dollar, but soon began trending downward until late on Wednesday. The euro dropped sharply on Wednesday, but quickly found a floor and rebounded, drifting higher against the US dollar until it surged to a new high for the week following the Federal Reserve's announcement that it would not raise rates this month. The Japanese yen had a bit of a whipsaw week against the dollar, moving higher in fits and starts before peaking on Tuesday and suddenly dropping lower. The yen moved lower through late Thursday and then surged back higher again. Both the yen and the euro appear set to close the week higher against the US dollar. Volatility should be expected to continue. Greece heads to the polls this weekend and the results should be in by Sunday. Early polls suggest that it will be a tight race between the Syriza Party and the New Democracy Party. Both of those groups are expected to continue to support the latest bailout conditions agreed to with Greece's international lenders in order to gain additional bailout funding for the debt-laden country. Popular Unity, the group that broke away from the Syriza Party after it was forced to agree to further bailouts, appears to be trailing last in the polls. Economists at Berkeley warned of the need for a strong Greek government to emerge in a research note this week, saying a weak government could put at risk the 86 billion euros program execution, further disbursement of official funds, official debt relief, and ultimately could reignite exit risks. Equally important votes in Spain and Portugal are slated to occur later this year as well, and with a referendum on remaining in the Eurozone also on the cards in the UK in the near future, the risks seem to be increasing that the Eurozone will become more and more fragmented. The ongoing migrant crisis in Europe and the safer areas of the Middle East is adding further socioeconomic pressure to already struggling smaller countries such as Greece and Hungary. Many migrants entering Europe are attempting to make safe passage to areas that they deem to be more prosperous, such as Germany, and as the weather begins to change through autumn and winter, the plight of these people as they travel, many by foot, will likely increase significantly as the weather deteriorates. Tensions continue to run high across Europe as the scale of the humanitarian crisis escalates. The rest of the world seems to have taken the view that the U.S. Federal Reserve's decision to hold interest rates steady at record lows this week, despite signs that the U.S. economy could support a liftoff, as a tacit admission that the global economy is much worse off than is frequently reported in the mainstream media, and that there is a potential for serious negative impacts to the U.S. should major economies in Asia and Europe fail to begin improving soon. Many analysts now feel that it will be December at the minimum before the Fed can possibly begin raising rates, and some are even projecting that they will be forced to hold rates steady through 2016 if the global economy continues to slow. Some even project that the Fed could even be forced to resume quantitative easing again if recession begins to take hold again across the globe. This weekend, Greece will be the area to watch as the results of yet another election come in on Sunday. It is widely believed that the two leading parties in the polls will remain dedicated to the latest set of reforms so as not to endanger the additional bailout funding that Greece so desperately needs. But as we have so often seen in that country, anything could happen. As continued global uncertainty rocks equities markets, precious metals may see a surge in demand as investors once again seek safe harbor for their cash. Wise investors continue to take advantage of buying opportunities, such as the one that presented itself early this week, to acquire more physical precious metals at discounted prices as part of a diversified investment portfolio. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, September 18th, 2015. Brought to you by Precious Metals International.